All right, should we go ahead and get started? You good, Dennis?
I am good to go.
All right. Welcome, everybody, to today's ERA Live. Thanks for joining us. Today, we welcome Dennis Reed, Senior Analyst with Edgewater Research. Many of you are familiar with Dennis and Edgewater, as Dennis frequently speaks at our chapter events and the ERA National Conference. And his firm, Edgewater, partners with ERA to put out the monthly industry trends survey and results. Today, Dennis is going to give us an economic and market recap of 2025 for the electronics components market and preview what's ahead in 2026. Before we get started, audience members, please be sure that your devices are muted. If you would like to ask a question, please type them in the chat box, and we will try our best to get to your questions as time allows. We are recording this session, and we will post the recording on the ERA website and our YouTube channel within 24 hours. So, Dennis, we are happy to have you today. Welcome, and go ahead and take it away.
Thank you, Claire, and thank everybody for joining us. And Happy New Year, as crazy as it is to say that. It is cold in Cleveland as well, but the lake is not frozen, so we'll take it. In terms of questions, please feel free to fire away. As Claire mentioned, yeah, I have enough information probably for call it 30 to 35 minutes. There should be plenty of time for Q&A. I know the market's changing, so hopefully everybody will take this update uh, from a positive side, because I think there's at least a lot more momentum entering this year than we've had for the last several, which naturally is not saying much. So, update or agenda, I should say, for today. For those who don't know us at Edgewater, I'll expand on the introduction. We'll talk about kind of where we are in the recovery. Again, we are in a recovery, just depending on your market or your segment. It might not be the recovery that you hoped for. We'll dig into the supply side for the market, then the demand side, and then we'll wrap up with our view on what sales will be, or what they finished up, I guess you should say, last year, and what they'll be for this year. So, who are we at Edgewater? We're an independent research company based in Cleveland, Ohio. We specialize in technology, internet, and then the consumer slash e-commerce space. We work with a number of the largest money managers throughout the world. So, think your hedge funds, mutual funds, pensions, et cetera, working with them to provide critical business insights through what we call our fundamental research process. And our reputation dates back over 2 decades. On our tech team alone, I think at this stage we're north of 70 plus years of experience. So we've been through plenty of these cycles. Of course, they're all different, they're all unique, but at least we've seen a few things and have some experience to draw back on. And then why do our customers work with us? As I mentioned in that fundamental research process, we're deeply connected in the industry. I spend my days, weeks, months, years engaging with people like yourself. It's been a great partnership with ERA, but we try to attempt to engage with those from sand to silicon across distribution, EMS, and then ultimately on kind of the buy side of the transaction from a component level. Our team focuses on the semiconductor space, the IP&E space, and then the distribution space as well. We're a trusted resource for the investment community. It helps us for a couple of reasons. Obviously it pays the bills, which is important, but equally, I would say, as important, it ultimately helps us get a line in sight in terms of where capital is flowing, that is ultimately paying for all the projects that each of you are working on a day-to-day basis. And then a critical partner with our largest technology companies. We work across our industry practice, supporting a number of functional areas from strategy to finance to procurement, sales, et cetera, helping them identify these trends and shape their strategies to capitalize on the opportunity. Just skip over that. And then a little bit about myself. Yeah, I started doing this job in 2005, have well over 15 years of experience covering semiconductors, memory, storage, distribution, et cetera, with several firms, including us here at Edgewater. Started in '05, took a little bit of a break as we moved throughout the country, doing a bunch of different things across the insurance, property casualty insurance marketplace, and then ultimately was lucky enough to join Edgewater back in 2000. um, initially in Boston and now actually with us in our headquarters in Cleveland. My contact info is here. I will get Claire and the team the slides after, so you guys will also have it. Any questions that don't make it through, please feel free to reach out, and I'll be happy to address those for you. So to start, we are indeed in a recovery. It just might not be the recovery that you hope for, which for those of you on the call who I may have spoken with, you probably heard me have said this line multiple times. So want to start by just laying out what transpired last year and really throughout most of the downside. So what you'll see from a blue line standpoint, or the solid blue line, those are the actual sales numbers across a basket of semiconductor interconnect suppliers and distributors that we track. The red line is the average of their sequential change in each of the given quarters. So again, when we look back to 2020, no need to say we obviously ran hot. We were in a shortage, operating well above sequential growth. We had strong pricing, etc. What goes up must come down. So when you get into that fourth quarter of 22, that is where the downturn kind of ultimately started. And you could see for several years, we undergrew the sequential changes, meaning, vis-a-vis we're burning inventory in the supply chain. And then as we moved into, this period in 2025, by and large, we tracked in line with, what you would call historical or 10 plus year historical sequential changes. And I think when you look backwards, not terribly surprising. A bulk of that inventory came out of the supply chain through 22 and 23. And, we were entering in this phase where, I think you could argue it's more of a mixed challenge, really than too much inventory, but also there was too much inventory. So as you move into the second quarter, again, it is a little bit of recent history. As you can see there, the actual results reported were roughly 15% sequential growth across, again, the basket of companies. In the normal historical quote unquote average for the second quarter is 5%. So, looking backwards, I think you would look at that and say, well, gosh, I think we're now finally in the recovery. We've burned inventory. The supply chain has gotten lean, and now we're re-entering into a phase where we're building inventory. And then in typical cycles, once you hit that first quarter above seasonal, that trend continues for multiple quarters. But unfortunately, as you see, that did not hold, and we ultimately ended up at, kind of a subish seasonal number for 3Q, and at least the initial outlook for 4Q is sub-seasonal. So, what I would tell you on the 4Q number, if you look at Wall Street numbers, they're wrong. At the end of the day, we think you'll have at least a seasonal quarter in the fourth quarter. But again, more importantly, framing this of you're in a recovery, but it's not the recovery you hope for. I think the narrative across the supply chain when we hit the downturn was, we had these great upside, whatever the high bar marks that we met were from a sales, profit, et cetera standpoint. This is the new normal, right? We all remember those commentaries, but the reality is the new normal was the old normal, which was just normal. And to say normal a few more times in that, what goes up must come down. So, this recovery has been a touch different. I think when you look across cycles, each and every one is. But the recovery or the above seasonal pattern in 2Q largely tariff aided. The good news is when you look at the results for the year that ultimately drove upside for 2025. The bad news is there wasn't a whole lot of sustainability because that was all geopolitical and tariff related. So, for those out there, again, I would tell you at a base level, from a high level, we are in a recovery again. It might not be the recovery that you hope for. Secondly, in terms of that better, here's just a basket or a sample of companies again that we track across the semi space. You've got an analog devices, the diodes, Infinias, etc., down to the arrows and avnets. And I'd also point out with this again to everybody there, the other thing that is different in this recovery is, the recovery is clearly not a rising tide raises all ship. Again, if you look at that Wall Street consensus estimate, you've got a company like TSM, with Wall Street forecasting 35% growth this year. You've got a company like Analog Devices forecasted at 23%. And then you offset that with somebody like an onsemi, where Wall Street has them 16%. So again, very, very wide discrepancy. So this recovery that we're in, again, one, it is a recovery. Two, it's not really equal to anybody or to all across the supply chain. And what I would tell you, the reasons behind each and every one of these are pretty idiosyncratic for each company. TSM clearly is benefiting from the AI boom. They manufacture all the NVIDIA processors. You look at a company like MPS with Wall Street estimates at 24%. They're a leading power management supply company in the AI space. Analog Devices is more in the classical cyclical. They have a couple of unique product exposures, in particular to China Auto, driving their calendar year 25 number. But they were also very, very proactive in cleaning up inventory in the supply chain. So they took their lumps early, and as a result, they're seeing their recovery early. You compare that to the ones that are underperforming at a high level, guys like onsemi, ST Micro, Microchip, those companies, even NXP to some extent, those companies in particular, they were the ones that were the strongest in pushing non-cancelable, non-returnable, PSP programs, etc. So the fallout from them as the downturn was obviously longer, but also deeper than relative to their peers. So again, from a recovery standpoint, I would again reiterate, and I don't think I could reiterate this enough. Indeed, we're in a recovery. Not all markets are experiencing the recovery, which I'm sure is not a surprise to everybody here, but not all markets are experiencing the same level of a recovery. And that also drives down to the idiosyncratic events. The recovery is not created equal for each individual supplier. So, this recovery appears to be shaped a little bit more with winners and losers relative to a more classical cyclical recovery where rising tides raise all ships. Secondly, with that, I think, it's also worth pointing out, the pricing actions that we had seen across the last upturn, and then the subsequent fallout from those prices through the downturn that ultimately makes this recovery feel different, right? We went through an environment where the single biggest barometer on growth was how much price or capacity how much price you wanted to take, I should say, and B, how much price or how much capacity you could bring on. We went through a downturn that you got the double whammy of both price and units falling. So again, we saw a sharp correction in pricing off the peak levels. You could see it starting to bounce back here. And I would tell you, as we flipped into 2026, the pricing environment still is actually turned and continues to be on an upward trend. We've seen pretty significant price moves across the interconnect supply chain, the passive supply chain, as well as the semi supply chain, with more to come as we continue into 2026. Reasons cited, and again, I should say these are non-memory related, because that's a whole different animal that I'll touch on throughout the presentation. But in the non-memory side, it's being tied to tightening fab capacity across the industry, rising front-end wafer costs, rising back-end wafer costs, increased labor, increased power, etc. We could debate the merits of each of those as we enter this year. But what I think, we drive to at the end is, if there was a lesson across the supplier base learned from the COVID-induced shortage, is that some of the dynamics have indeed changed. I think at the first sign of tightness going forward, the supply chain is going to react. They're going to take price. And again, so I think you're in an environment where it will be inflationary for 2026. I think that's ultimately going to aid in the growth numbers that we'll bring out at the end. But again, I think the bigger view to look at it is over time, and you could see it just in this chart, right? There, the trend line is down, is a pretty straight line down with a couple of minor blips up. We appear to have bucked that across the cycle here, and we expect that to continue going forward. how did we get into that and shifting a little bit into the supply side of the equation? How did we ultimately end up in this situation? So this is looking at the CapEx across, the semiconductor and the passive and discrete marketplace, including the compute suppliers, the memory suppliers, foundry, and then the passive discrete guys. So when you look at it clearly, we overspent in 19, 20, and 21 and into 22. In aggregate, you had 3 straight years between 18, 19, and 20 of double-digit growth, followed by a softer year in 21, and then again double-digit growth in 2022. So we had a long window of an upward trend in capacity. Admittedly, a lot of that is driven out of the compute marketplace, most namely the memory space. But it's important to note the last time prior to this cycle, this CapEx cycle, that we had 3 straight years of double-digit capacity growth or CapEx growth, I should say, was in 99, 2000, 2001. We all know how that ended. And again, with the benefit of hindsight, I think we all know how ultimately this upturn ended. I will show it out, and I think it's important because obviously the compute and foundry marketplace make up a significant amount of CapEx, and I think the dynamics, especially surrounding AI, are significantly different from a demand environment there. So stripping out memory, stripping out compute, stripping out foundry, just looking at the CapEx on the semi or broadline semi side, and then the passive discrete suppliers. Admittedly, at first blush, I would have expected this data to look a little bit more conservative without kind of the AI impact. However, as you can see, the actual spending pattern through 19 into 2021 was actually significantly more aggressive from the broadline semi suppliers. It's a fair disclosure that Texas Instruments does make up a disproportionate amount of this number. So this is kind of TI influenced, if you will. But again, this is a long way of saying the industry has brought on a great deal of capacity. And even where we are, or where we're expected to be in 2026, we're operating at a number that's still 50% higher than 2025 after, relatively sharp, prudent CapEx reductions in 24 and 25. So again, there is plenty of capacity out there. Any type of supply tightening that I talked through today, we think it is much more of a function of that migration from moving from underutilized to utilized, as opposed to, the narrative that creeped throughout the last shortage of, MOSFETs, as an example, will be short forever. You'll never get another MOSFET in your life. We don't think that's the case. We think there is ample capacity out there, but again, to bring that idled capacity online takes time. That creates bottlenecks when bookings improve, et cetera, and that causes the lead times to extend. Sticking with the supply side and looking at the inventory, and again, I think it's worth noting that this is, a touch backward looking. When you look at the inventory, there's actually not a story really to tell. As a supply chain, we've done a very good job of taking inventory out over the last several years. What I would tell you right now, where we sit on January 13th or 14th, whatever today is inventory in the supply chain is much more of a mix challenge than it is an actual inventory. From a dollar standpoint, I do think inventory levels are structurally higher than what we've seen throughout history. That structurally higher inventory dollar number is largely attributed to the ASPs around the advanced AI programs flowing through the inventory. So you'll see the supply chain, including AI, run through, a prolonged period where dollars run higher. But again, when you get outside of the AI related, the supply chain's done a good job to bringing it to a more normalized level. I think when you look across the channel, meaning EMS, non-AI, distribution, and your broadline suppliers, inventory days and dollars have come down. They're still a touch heavy on the day side, and that ultimately comes down the equation of mix. pulling a little bit out, of a more real-time view. This is looking at the ERA survey, and we'll see a more updated one in a month with everybody in Austin, which I look forward to rolling out. But again, I think this kind of tells you the same story. When you look across the customer, the interconnect, the passive, the semis, and ultimately average of all of them, as you can see throughout the history of the survey, we have gone from a situation where we were all deemed too high to too low to effectively kind of balance. So right now, we are operating in an environment across the supply chain where inventory levels are certainly cleaner. Again, I think when you go to that idiosyncratic recovery that I talked about, it is not clean by every supplier. It is not clean by every single commodity. But again, relative to where we were 6, 12, 18 months ago, we're in a much, much better place from an inventory standpoint. Shifting from the side and moving into the demand side, at first I'll start with the PC outlook for 2026. Again, 2025 still listed as an estimate, so finalized numbers haven't come out from Gartner and iSupply. But when you look at 2025, it'll wrap up, right around in that kind of high 260 to 270, 270 million unit number. The forecast initially out of the gate, today are in that 4 to 5% range. When you think about, where does ultimately this go in 2026, I think, the PC market is a market that we'd actually highlight that probably has the most significant risk to it. And that risk is entirely tied to the memory pricing and memory allocation. So official forecasts, again, are, calling in that low to mid, call it 3 to 5%, depending on the OEM. You're starting to get some indication from some of your more consumer-centric PC OEMs that units could be as bad as down 10 for this year, and that is purely memory driven. And what I mean by that is the consumer PC market largely operates under an environment where memory prices are allocated at 10% of the retail price. So if you think a $500 machine you may see at Best Buy, that PC typically has $50 worth of memory. But if that has doubled, which it has this year, you need to raise the price on that consumer-based PC to $1,000 to make the math work. So yeah, I think you'll see some of the low and mid-range PCs being removed from the marketplace, one. And then that questions in the demand elasticity and whether or not the consumer will move higher, especially without the COVID-induced demand push as people went remote. Additionally, there's significant risk in terms of will these OEMs even get the allocated memory that they're hoping for. So if you think in the pecking order of the memory allocation this year, first and foremost are your AI customers, so that's servicing the high bandwidth memory. Secondly is your US cloud providers, right? Your guys like AWS, Metas, et cetera, of the world. Third is probably your Chinese cloud/hyperscales. Fourth is your server. And then fifth, sixth kind of combined ultimately becomes PC and smartphone. So again, I think, the initial outlook and the way to frame this year from a PC standpoint is, a march and a return to normal with probably more risk than upside from the PC, and the risk is entirely driven by the memory markets. When you look at the server marketplace, I'll run through kind of the three different ones, and I think I hit on it initially with the memory outlook. The overarching story is very, very similar to the PC marketplace, where the initial unit forecasts remain healthy. If memory were not a problem, I would tell you all that the unit numbers could probably be double what they are. So this is a relatively conservative 4 to 5%, assuming some customers are allocated and not able to meet demand. But again, when you think of the drivers across the AI marketplace, or the AI server marketplace, I should say, exited the year about 2.5 million units last year, should approach 4 to 4.5 million this year. So again, strong AI growth. The delta in the memory space has candidly been from from your hyperscalers in the US that have returned to spend on their core data center. So your cloud-based server demand remains robust, and then your enterprise on-prem remains challenged. But again, to frame it the same way, when you think of, what could go right, what could go wrong for this year, while the outlook is certainly positive and the AI outlook is certainly robust, when you think of the overall outlook, I think the biggest risk, here for the servers market is clearly memory. I would take it a step further to differentiate a little bit from the PC market. It's probably less on price, more on just allocation, and what that could mean to potential builds. Again, it's the age-old kind of golden screw. When you're operating in an environment where large, substantial Chinese hyperscalers like an Alibaba or a Tencent are in some cases only getting 70% of the DRAM that they've requested in the first quarter of the year. That shows you're in a pretty tight memory marketplace right now, with no incremental capacity candidly expected until the middle of next year. So, I would tell you, when you look at the marketplace again, good underlying unit demand, good underlying fundamentals. Your risk is ultimately whether allocation creeps in and creates that golden screw environment around the memory side. Moving to the smartphone marketplace, really, really quick here. When you look at the market, 2025 is a 1.2, 2 billion and change, 881 million in 5G devices. So you're almost arguably fully penetrated from a 5G standpoint. When you flip forward to this year, the forecast is flat. And the 5G number is about 900 million, which is why I haven't actually updated the chart, because there's no real change here. Same, excuse me, same exact story I would say to the PCs. I referenced it on the PC slide. When you look at that pecking order of where bits of memory are being allocated, mobile phones and ultimately PCs are near the bottom. And we're not even talking about the embedded market, which everyone I'm here sure is very well aware. Several of your major guys have walked away from it last year. You're left with the other suppliers who are taking substantial price increases. And if you don't like the price increase, they'll go to the customer down the road and do the same. But again, when you think of how this plays out, it'll more likely, if we're right and there's a memory risk, it'll more likely impact mix. So the mix will be biased more to the high-end devices, and then that ultimately, should impact your emerging markets. So think your China's, Latin America's, et cetera, that create additional risk off that flat number for 2025. Moving into the automotive marketplace, again, haven't gotten the overall production, but think they're, kind of flattish last year from a global basis. you know, Areas of goodness in terms of all of 2025, the Chinese market was hot, in particular the Chinese EV market. Moving forward, right now we've got production set up at kind of flat to up slightly. So again, well below those peak levels in 2017, 2018. And I think when you think of the automotive market in general, it's really going to be a matter of mix that ultimately drives the results. Clearly, we've seen some goodness. Inventory is in a much, much healthier environment. There are some geopolitical disruptions around Nexperia, which has created some movement. But again, inventory at the component level looks good. Production levels look flat. What I would highlight, I think the challenge is going to remain kind of the mix. This should be one of the more bullish or robust outlooks for the internal combustion engine over the last several years relative to EV. In particular, and again, I think it's worth noting, but if you look at what the Chinese government released for their economic outlook in 2025, that was the first year in like 3 to 4 years that they have left EVs off as a strategic priority. Their economic agenda was entirely centered around AI, domestic chip manufacturing, et cetera, and it was eerily absent again of EVs. So it's worth noting when you think of that mix as it relates to the electronic component that we're operating in an environment with relatively again, healthy inventories, okay-ish production, but you don't have the mix kicker So, ultimately, what does that mean for everybody? It's very similar to that broader recovery. It's going to be idiosyncratic to the programs you're on. It's going to be where, the OEM, the program, the vehicles, it's not clearly going to be a rising tide. But again, in this type of operating environment, this is the one that kind of nets out to that mid high single digit, 6 to 8% grower without the fluctuations of inventory. As we move into the demand in the U.S., the U.S. SAR, ultimately Ford came out earlier this week or late last week, and Ford and GM and said the SAR was 16 million, roughly flattish with last year. So again, I think it's very, very similar of the good news, bad news. When you look at the momentum through the year, we clearly saw some goodness in individual months going back to the tariff time period in that March, April, May. I'm sure if anybody recalls and paid attention to the commercials that they saw on TV, all the local car dealers were offering promotions around we have inventory pre-tariffed inventory, prices are going up, et cetera, et cetera. That did drive some near-term momentum. So you did see the SAR, in and around the Liberation Day, move to the 17 and a half, 18 million. But again, ultimately for the year, we ended up in that 16.3, 16.4, 16.5 range, which was flat. So again, from a good news standpoint, despite that geopolitical disruption or noise, there was ultimately no impact, and those forecasts last year came in line. From a bad news standpoint, it would have been nice, clearly, if there was some momentum and that carried through and there was upside. As we turn the calendar into this year, I would tell you it's kind of more of the same. The SAR forecast for this year are kind of 16.3 plus or minus. So again, we're looking at, a relatively, call it flattish environment from an end demand standpoint. I think the same story holds when you think of potential memory with DDR4 and some potential disruption there. That's ultimately the risk to the numbers. And then so you have memory as a risk, and then, we'll see what happens with interest rates, et cetera. I'm sure there will be somebody, I think there's an economist in February that would be more adept at predicting where the Fed funds rate's going to go. But again, in general, I would paint a picture for auto that's cautiously optimistic. The supply side looks better. The end demand side and production side has some question marks, but there will clearly be a year of winners and losers, depending on, what programs you're on and OEMs you support. Moving to the industrial marketplace, obviously, honestly, not a ton to talk about here. You can see the trend after the wild gyrations around the COVID and ultimately the shutdown years. We've been operating in an environment that's been flat, plus or minus, kind of each of the last, each month over the last several years. And that environment overall continues and is expected to continue into 2026. When we think about it fundamentally, this coincides and very much agrees with what you see from a global PMI standpoint, which again is hovered in that, call it, 48, 49, 50. So either mild contraction, mild expansions environment. So again, that's your top-down manufacturing. What I will tell you is some good news here and some rays of hope, especially for the ERA community. Um, you're starting to see some early signs of the tentacles of AI creep down into your industrial business. It is very, very individual OEMs or subsectors. So think markets like ATE, clearly a benefit from the memory boom. Think markets like power supply and power distribution. At the end of the day, we're going to have to hook these data centers up to the grid somehow to power them. So, what I would say, I don't have any hard concrete evidence on real, especially that power side, but anecdotally, what we have seen in our conversations across the supply chain is a number of larger suppliers have been able to work backwards, and when they saw a nice little uptick in their industrial business and reached out through the rep community, distribution, et cetera, and traced it back to the customer level. In most cases, those were tied to seeing some energy infrastructure builds tied to AI. So, I think that's a little bit of goodness potentially from the demand side when you think fundamentally for demand and how this business grows, in line with its historical average. It's automation, it's robotics, it's in the factory, it's energy efficiency. And now again, you could add a maybe first or second derivative with that power and grid and infrastructure, starting to have a real demand driver behind it with some of the data center build outs here in the US. Moving over to the defense industry, unfortunately, still one of the strongest markets that we see. 'Cause unfortunately, the world is, equally less safe as it was over the last couple of years. I read in like the Wall Street Journal or something. Unfortunately, the war in Ukraine is eclipsed 1,400 days or something like that. There's, continued conflicts and unrest in the Middle East. I didn't have it on my big bingo card that we were going to arrest a president out of a Latin American country. So geopolitically, I don't think that top-down driver is getting any easier, and that's obviously the understatement of the century. But I would say, more importantly, I think if you look at the shipments over a 20-year window, that blue, line chart or bar chart, it is continuously up and to the right. And then when you look at the year over years, obviously it's volatile, and that's military going to do what military is going to do. But when we're in an environment where, near term, I would say, it's quote unquote less safe than we are. Physical assets have been deployed and positioned throughout the world to support the ongoing conflicts. That gives way to a large tail from both a order and as well as a shipment as we replenish those inventories. But more importantly for our industry, I think if you dig through Pentagon budgets, you'd find, I mean, I know you would find that, a greater percentage of their budget is being allocated to what I'd call the digital army, right? You look at companies like Anduril, they didn't exist 5 years ago, and they've got, a 50+ billion-dollar backlog. So, you are seeing our armed service be more digitalized. You're seeing a move towards space in the satellite and communication space. You're seeing a move towards protecting against cyber warfare. That's, obviously a debate. Does that fall in compute or does that fall into defense? But again, a greater deal of the spend is ultimately being shifted to fight our enemies of the future, and our enemies of the future are across the Pacific and will likely be involved an island that manufactures the bulk of the semiconductors that we consume. So, again, not a ton of a change, but still a robust outlook. It will be volatile. It's project driven. I think for those that support this space, that is not surprising. But again, definitely a good secular trend in the defense space. So as we shift to what does all of this mean, trying to stay within a time to leave for question, again, for 2026, on this chart, we have the sales at up 12, 13x memory, and then logic, at 6. What I would tell you, and for those who know us, we typically update our actual numbers. So these are too low right now. When I put these, we update them every quarter. When I updated these in October, yeah, I painted a scenario of what can go right and what can go wrong. And I think, that ultimately plays through in the same fashion with a couple of different nuances. So if you take WSTS, which we base from the history for this, they've got the overall industry up 26. If you strip the memory, I think it's 22. If you strip memory and logic, it's 9. I'd actually agree with them. 90 days ago, it painted a picture for it to be better than the 6% number for the broadline space. We would need to see lead times begin to stretch, which in turn drives customers to put bookings, orders, et cetera, on distribution. And then that classical cyclical pattern repeats. Back then, 90 days ago, if you would have asked me when it occurred, I would have said probably after the Lunar New Year. Uh, yeah, I think fundamentally we were right with kind of the direction of it. The timing of it came a little bit earlier. Throughout the fourth quarter, we've seen lead times move a bit. I think it's still debatable. Is this a 2Q head fake, if you will, or is there some sustainability? Again, and that goes to the geopolitical disruptions. But again, where we sit, I would say, that upside scenario from 90 days ago, again, 7, 8, 9% is probably the more likely base case scenario right now. So again, a much more robust outlook from the risk to this year, and I won't go into any more detail because I feel like I've talked about memory enough. But 90 days ago, I would have said it was tariff impact on inflation, et cetera, as your biggest risk. Right now, what I would tell you is it's all memory. As we shift on to the overall sales environment for interconnect, again 6% for next year. The one caveat and kicker I would say to that, one of your major tier one interconnect suppliers has passed through roughly a 5% price increase effective January 1 on the channel. We'll see how much of that holds on the direct business, but I think, relative to this forecast of 6%, there will be a pricing tailwind behind it. So again, I think there could be upside to interconnect from a pricing standpoint. And then lastly, shifting over to the passive side, about a 5% number last year, pretty similar outlook for this year. What I would tell you is, that outlook's based on a couple of points of volume, couple of points of price. Again, I think the pricing could go higher in passives. We've started to see, instances, tantalum capacitors are 50 to 52 weeks, tantalum polymers 52 weeks. Some of your higher end MLCCs have stretched to 20 to 26 range. You've seen some resistors pop out a bit. So again, you've seen some of the supply side dynamics move a bit more aggressively in the passive space, to date haven't adjusted because we'll kind of wait to see where the dust settles from both the price and availability. But again, I would tell you barring a major memory disruption, the bias is still higher. And then, just lastly, impact and things we're looking at in 26 and beyond, tariffs, memory, inflation, et cetera. What does that ultimately do to demand? Today, it's been, largely non-existent. A completely different discussion on the AI. What inning are we in, or should you say, how sustainable is this investment cycle? The numbers are staggering. You could just look at the NVIDIA data center revenues that were 15 billion in their fiscal 2023 third quarter, or fiscal 23, and they've grown at 131% CAGR, and we're not talking about small numbers here. So again, some of the growth in AI has been staggering. What I would tell you as it relates, there's no smoking gun for this year or next. The AI spend is expected to continue, but again, it's tough when you look at some of the data around it, from Meta offering $100 million pay packages, OpenAI's valuation, the fact that they just burn cash every year and they're not economically viable despite a $500 billion valuation. Again, these raise some question marks on the sustainability, or maybe I should say, ultimately what this looks like long term. So with that, Claire, I have covered a lot. What questions does everybody have?
Okay, yeah, definitely. We have some time for questions, so type them in the chat. So I think back one in one of your first slides, when you were showing that list of semiconductor firms. So Brooke wanted to know, do you have any view of growth opportunities for the semiconductor firm Qualcomm?
Yeah. Qualcomm's an interesting one, and it's an area that we're doing more work on now. So I would say we're not nearly as much of a quote unquote expert as we would be of more of your broadline guys, but two major levers for Qualcomm. The risk for them is Apple continues to move product in-house. And that's been ongoing, and they've been able to dodge that to some extent over the years. But that's, always an evolving risk or emerging risk for Qualcomm as it relates to Apple, who's your largest handset OEM, et cetera. From a growth opportunity, Um, yeah, I think they're playing well in kind of that IoT connected space. Again, if you think fundamentally of a factory of a future, it's sensing, power, data, and some type of communications that infrastructure that drive it, and that's ultimately right in Qualcomm's wheelhouse. So, I see an opportunity in kind of that IoT advanced communication space at the factory level. They've done well and competed well in various auto programs around ADAS and everything else. But I think the real challenge is going to be when you have a large major customer like an Apple that, potentially is moving more business. Is it enough for those smaller ones to offset it?
Okay, great. Okay, Bruce Scoggin wanted to know, how do you address the statement that manufacturing is contracting and has been for most of 2025?
Bruce, are you talking in the from like a PMI standpoint? Can I ask you that? Okay. Um,
What I've been seeing is just a general contracting.
okay, general, yeah. Um, I think when you look back over um a longer period of time, even then the COVID shortage, right, and then the subsequent downturn. Um, as it relates to the component business over time, it's grown 6 to 8%. And, in that same time, over the last 20 years, we've seen close to we've seen over $4 trillion of foreign direct investment into China. God knows how much China plugged into their own economy, or into their own investment dollars to age and becoming, kind of the breadbasket or manufacturing hub for every single thing in the world. So, I think when we think about manufacturing in general, PMIs again have held, in that, 48, 49. You think about manufacturing, we know from the US economy has been built on services, as opposed to hard manufacturing. And this again is going over, a longer 20 plus year window. And then there's a productivity equation, and we'll I think the jury's still out on this whole AI phenomenon. When I listen to podcasts or read, various articles, whether you listen to Sam Altman's or the Jensen Huangs or, whoever, you know, there's such a there's such a wide angle of outcomes right now on what AI can do to manufacturing in general. There's a train of thought that says, AI will unleash so much productivity that the only thing every American needs is a universal income. It's all going to be great, and everybody gets to go out and play golf, and they're going to be happy. I don't know. That seems really awesome, right? If that works. Um, there is a train of thought that says, it's going to unleash the robots and they have no filters and it's all ones and zeros. And at the end of the day, they're going to ultimately nuke every single city and civilization is going to cease to exist. Again, I think you could put, call it tinfoil hats on both those outcomes. But, the U.S. economy has led, over the history. And I think you could, even backing out of the manufacturing or going into like a subsegment of it, um, the US economy controls something like sub 10% of all semiconductor manufacturing globally, where China is at like 70, but we still control north of 65% of all intellectual property. So, that shift, Bruce, has transpired over time. What we maybe potentially lack in 2025 from a manufacturing prowess. Even if we were to reshore everything, I'd be the first to say, A, I don't think we could do it. B, it's also not 1985 where we have the labor to do it. Um, we've led with innovation. So I think, when you think about that and how it ties back, vis-a-vis you take inventory shifts, and I know this is impossible because inventory is always only balanced on like that 1 minute interval when the quarter shifts, and then you're either supply or excess. But if you look at it and say inventory shift, whether it's driving efficiencies, whether it's automating, whether it's doing more with less, even in a contracting environment, that's ultimately what's going to drive our business.
All right. Okay, I see one more question in the chat. It's from Nate. Oops, my chat just disappeared. Hang on. Nate says, "Do you see any impact from the recent increase in raw materials prices, specifically silver, copper, and gold?"
Yeah, Nate, the without naming a supplier, I referenced one of your big three interconnect suppliers recently just passed through, close to a 5% price increase. Um, a bulk of that is based on what you listed. So I think you're seeing the material increase in particular in the interconnect supplier. So your big three, if you will, are anywhere from 3 to 5%, which is higher than normal. That's all gold, silver, copper, etc. Some of your smaller interconnect suppliers have taken more aggressive pricing. So yeah, I think they're the one with the most line of sight. You've seen some of the semi guys come through with fairly robust prices, including someone like an Analog Devices, where they're targeting anywhere 10 to 15% as of February 1. They'll point to gold, silver, labor, power, etc. I think in the case for semis, it's more of the market's just a little tighter at the margin, and we've proven in the last upcycle that we're going to raise price when it gets tight. I think the real warranted impact is what you're seeing in interconnect.
Okay. That's all that I see in the chat, Dennis. So,
Awesome.
any final thoughts? Dennis will be presenting at the conference in Austin in February. He'll be doing a breakout session. So catch him there if you'll be there. Any final words?
Thank you guys for joining us.
Yeah. Thanks,
Thank
everybody.
you, Dennis, for joining us. Appreciate it.
Yes, it was wonderful as always, super informative, valuable, and we thank you, Dennis, for being here today. The recording of this session will be posted on the ERA Live section of our website and our YouTube channel within 24 hours. And I did just post the link to our YouTube channel in the chat. The next ERA Live will take place on Tuesday, February 10th, and it will be a preview of what to expect for the conference in Austin, which takes place February 22nd to the 24th. We'll be talking about what's new this year. There's an entirely new venue and some new formatting to the event, and we're excited to share it all with you. So we will see everyone then, and thanks, everyone. Have a good day.
Thank you.